Right, good evening and welcome to this FAS webinar on budgeting, how to do it and why to do it. I am Osla Jamwal Fraser, an agricultural consultant up in the Shetland office for SAC Consulting, and Andrew, who will be taking tonight's webinar, is Andrew Coalter from the Perth office. He's one of our senior consultants and area manager for Perth, and also a chartered accountant. So he's going to give us a walkthrough on budgeting, both whole business budgeting and cash flow budgeting. So without further ado, I will hand you over to him. A couple of tiny things to remember. We will be taking questions. If you use the chat box to pop your questions or comments in, and we'll deal with them at the end when Andrew has given his presentation. But please do fire questions in the chat as they come to your mind, and we'll deal with them at the end. At the end of the webinar, there will also be a wee poll that comes up on the screen just to ask you a few questions. It's 3 questions, I think, about how you found the webinar. And afterwards, there will be a follow-up email from the FAS team just to see how you found it and if you have any comments or feedback to give us. So I'll hand you over to Andrew.
That's great. Thank you very much. So I'll just share my slides first and we'll see if that works.
Perfect. I can see them.
There we go. Success. Always a nervous start. Okay, so good evening. So as Osla said, my name's Andrew Coalter. So I'm a senior agricultural consultant and area manager for SAC Consulting in our Perth office. As Osla's already mentioned, I am a chartered accountant as well. So as a chartered accountant, my role at SAC includes responsibility for things like our bookkeeping service, but also for helping develop the business work of consultancy within the business and helping a lot of farm businesses with their finances. So I've spent a number of years working in practice as an accountant, and this evening I'm going to be focusing on the process of budgeting within farming businesses. So discussing what that looks like and providing some advice for how to do it. So as Osla's already said, if you have any questions, please just put them into the chat box. In the interest of time, we've decided to save those to the end, but we will try and get to as many of those as we can. So farm business budgeting. So let's be frank about it. A lot of us admit to being farmers first and business owners second. We would rather spend time on planning crop rotations or breeding plans, or sometimes even clearing out sheds than spending time on budgeting. But really, you're just hurting your own business by not engaging with your numbers. So today, we're going to focus on a few key areas. So firstly, why your business should be budgeting. Secondly, what types of budgeting you could maybe think about doing, particularly if you're new to this. So that will include everything from basic gross margins forecasting through to full cash flows as well. And then at the end, a few bits of advice for successful budgeting systems and how we monitor those as well. Ultimately, your use and your utilization of the budgets that you create are as important as the process itself. But hopefully this will give you more informed opinions to start planning for your own business. So why should a business budget? I'm going to start here by thinking of why a farming business or any business should consider going through this process in the first place. So for a business to function effectively, you need to have a handle on your financial position. So this includes monitoring your cash balance and your reserves, along with tracking whether each enterprise in your farm is making or losing money. And understanding your financial position lets you make decisions that are based on facts. And it's an important part of business management, ultimately, regardless of what industry you're in. Budgeting is a really good strategic tool that allocates resources and helps you forecast the financial outcomes of that. And that's not only relevant, but it's essential for growth and prosperity in business. So within agriculture, we have the unique challenge, such as reliance on the weather, market volatility, changing subsidy landscape, that's coming in the next few years that really underscores to me the importance of financial planning. And the benefit of budgeting is that you'll be able to support what you're going to do or show you what you need to change to get there. So yeah, I've came across this quote recently from Doug Avery, which I thought just summarized quite nicely, um, the attitude that we should be having towards our business work or any sort of work which involves, account analysis or budgeting. Um, Pay someone to do the other jobs in your farm. Don't pay somebody to do your books. That's where you really learn about your business, and that's where you can get a lot of value out of it as well. Um, there's a point there in the bottom of the screen as well, which I'll come to later on, that actually, if we're honest, one of the most common reasons that we get asked to do this sort of work, or that we need to look at this sort of work, is for interacting with the bank. And in reality, for a lot of people, budgeting is something that's far down the list, and we only interact with it when we have to. So one of the interesting changes over the years with the reduction of bricks and mortar banks is perhaps at that historic annual meeting with a bank manager, where you had to outline your plans for servicing your debt, has now maybe disappeared. But if that's something you used to do, what are you doing now instead to plan for success? And also thinking about banks as well, budgeting for when you're seeking additional finance is one of the most common scenarios when farmers are forced into budgeting and planning. When you're creating a forecast for a bank loan, it's common to, need 3 or even 5 years of cash flows, but sometimes even just evidence of past profitability and high level evidence of future viability might be enough to satisfy a banker's needs. Ultimately, budgeting is also useful for identification of problems. If you complete a budget and you see it's not going to work before you start, that's a real advantage, and you can perhaps identify where the problems are going to be. As a slight aside, it's also helpful to point out that budgeting allows you to assess what investments you might be able to make, or indeed need or want to make, and how to achieve and maintain those levels of profitability. Or actually, that the profitability of your business may be what you need to fuel personal investment or drawings for outside the farm business. So it's just something else to think about as well. So this evening, I'm going to cover 3 main types of budget. So firstly, we're going to look at gross margin budgeting. This is where we budget or forecast on an individual enterprise level, like spring barley or suckler cows, to see how we think that enterprise will perform in isolation. This is really quite a common form of forecasting in agriculture, and it's actually quite a powerful tool. Secondly, we'll look fairly briefly at how we can take that further and do some options appraisal with partial budgets. So looking at what the associated benefits or costs of making a partial change to your business plan could be. And thirdly, we're going to have a look at cash flow budgeting and how that can provide your business with a really useful forecast of what is to come in the year or multiple years ahead. The reason I'm deliberately looking at that last is because hopefully that will allow you to consider how completing gross margin budgets can help provide you with the information that you need for cash flow forecasting situations. There are a variety of software packages and online tools that help complete each of these sorts of budgets, but there's absolutely no reason why this can't be done with just a pen and paper, or better still, just a simple Excel spreadsheet, which is quite often what I see. So my first question is this: what's making money on your farm? What is actually making you money? Surprisingly, many people I speak to don't know the answer to that. I've dealt with a lot of farmers over the years who know that at the end of the year, they have money in the bank account, but they're not really sure where it exactly came from. So is it your winter wheat? Is it your suckler cows? Or even if you do know that, do you know how much it's changed over time? Has that margin got bigger or smaller on those enterprises? So gross margin budgeting is essentially a financial planning strategy that that really revolves around evaluating the difference between your revenue and your variable costs within a business operation. So by focusing solely on these key components, it provides a clear and concise overview of the potential profitability of an individual venture. So it's quite simple, but actually it can be quite insightful, allowing you to quickly gauge the financial viability of your activities and help you make informed decisions based on revenue generation and the direct costs associated with that production. So it's something that can be used in any number of scenarios. And later on in the slides, I've included some screenshotted examples from the Farm Management Handbook that show just a few examples of this in practice. You'll see in the slide here, I've given the examples of crops and livestock, but there's no reason why we can't consider what the gross margin of any diversified income stream or other incomes of the business might be. It is, however, really important to take all of this within the context of the wider business costs, which we will come on to later. So to explain the inputs we consider in gross margin budgeting, we break it down into two sections. So firstly, we've got our revenue. So it's pretty straightforward. It's just the income which is generated from the specific enterprise that you're considering. So for an arable crop, that would be your grain and your straw. For something like suckler cows, that would be the calf sales. We've got direct income from beef calf scheme claims. That's directly from the enterprise, or cull cow sales. They would all come into your revenue. It's just the income that is directly attributed to the enterprise in question. For your variable costs, those are the costs that are directly linked to what you're producing. So again, for an arable crop, that would generally be your seeds, your fertilizer, your sprays, any contracting charges, or any other specific costs associated with growing that crop. So if we take the variable cost off our revenue, it's going to give us a gross margin for that individual enterprise. So these budgets can therefore tell us whether each enterprise in isolation has the potential to produce a profit or a loss from the production alone. So SAC Consulting and the Farm Advisory Service produce an annual publication called the Farm Management Handbook. So it gives gross margins for all sorts of arable and livestock enterprises and is a really useful starting point in this or any sort of budgeting work. So you can buy a physical copy of the book from SAC, which is really useful to have in paper format, but you can get a free PDF version online. So here are some examples of gross margin budgets taken from the most recent version of the Farm Management Handbook that was released within the last month for 2023-2024. So you can see here some arable examples and shows what sort of detail you should be including in these forecasts. Effectively, the more detail you add, the more credible your gross margin budget will be, and the easier it will be to update in the future. So including physical data in here helps to back up what you've done, and it makes it easier to update the next time round. So in these examples, we have three different sets of numbers. The first, so to take spring barley, the first column is based on a grain yield of 4 tons to the hectare. The second is if your yield is 5.5, and the third is if you get higher yields of 7.5 tons, and the impact that makes. So putting in those assumptions that you're making for your business just adds a bit more credibility and makes it much easier to update in future. So on this screen, we have some example of livestock enterprises, again, taken from the Farm Management Handbook. I've made a note of the web address down at the bottom, but the quickest way if you can't click on that, is just to Google the Farm Management Handbook. It's readily available online for free.
Andrew, I've just popped it in the chat for everyone.
Fantastic. Thank you very much. That's really helpful. So you can see here the sort of income and expense that I'm talking about. So it's your revenue at the top, take off your variable costs to get us to your gross margin. And you can present this in any way you like. In this case, for dairy cows, we've got a gross margin per cow, but we can also show that as the gross margin per hectare that animal is using as well. So, bit of a summary on gross margin budgeting then. So we've got some pros and some cons here. So gross margins are quite simple. They're easy to understand, they're easy to calculate, and they're really helpful in evaluating different enterprises and which perhaps are making more money than others. It's something that you can do forward planning or retrospectively. Obviously, we're talking about budgeting, and we would ordinarily think of that as a future planning exercise. Um, but if you were to take your year-end accounts, quite often they don't come for 6, 9 months after your year end has passed. So sitting down to do this exercise and actually sometimes just saying, how has my year gone at this stage? That might be now post harvest, where you sit down and think for the harvest season that we've just come through, how has that gone? And totting that up to see what that looks like before planning the next cropping cycle, which is about to start or perhaps has started already. It's really useful as a forward planning tool as well. Again, with any of these sorts of things, the better information you put in, the better you'll get out of it as well. But there's a few drawbacks here I wanted to point out as well. Gross margin budgeting doesn't consider fixed costs. So we can't just stop there in terms of farm business planning. We need to take it a bit further. We need to expand it to a whole farm budget. And it doesn't cover the timing of cash flows. So that's a con with a few of these different types of budgets that I'll show you. And actually the timing of cash flows can be really important, particularly if your cash flow is under strain and you need to be a bit more wary of that. Just quite a helpful quote here from the Farm Management Handbook. The gross margin's not a profit figure. There are other things we need to consider within this. If we were to think of accounting profit, there would be stock movements and those sorts of things as well. But it does quickly tell you if there's the potential there for profitability from the enterprise itself. So gross margins are a starting point, but we need to take it from there to build up a picture of the whole farm. So we start with our gross margins, and we can add in any other income we have. So that could be things like grant income, your basic payment scheme, maybe you do some contracting, way leaves income, any sort of diversification, or perhaps you have rental income, to get to a whole farm gross margin. What's the gross margin of your entire farming business? We then need to take off our fixed costs. With any sort of forecasting, this is one that's worth taking a bit of time to think about and making sure we include absolutely everything we can do in that to get a realistic view. So that could be things like your labor costs, your machinery costs, or property repairs, or heat and light, or all those other costs that don't really have a home, and actually taking off your finance charges to get to what is effectively a forecasted profit figure. Once you get to the bottom, this is the point at which you can really start to look at your whole business and see if there is potential for profit for the year ahead, or if further work or changes need done. Tweaking figures or tweaking your business plans at this stage is easier to do now when you're planning compared to 6 months in when you've already committed to a certain crop type or a certain class of livestock that you're dealing with for that farming cycle. So to briefly touch on partial budgeting as well then. So partial budgeting is a financial analysis technique used to evaluate the potential impact of specific changes or modifications to a business, effectively like a what if analysis. So it involves assessing the costs and the benefits associated with a decision or alteration, such as, changing what you grow or introducing new technologies or making adjustments to your production techniques and methods. Unlike comprehensive whole farm budgeting, which considers all financial aspects, partial budgeting narrows this right down to focus on incremental changes that result from the decision under consideration. So for example, if you were to swap out winter barley for spring barley, or if you were to take out the cows and take off suckler cows and add spring barley in instead, those sorts of changes in isolation. By comparing these changes, partial budgets enable you to make more informed decisions by determining whether that proposed alteration would have a positive or negative impact on your overall profitability. So it's quite a practical tool for breaking down complex decisions into fairly manageable financial components. So to give an example here on the screen, this is quite a typical layout for a partial budget. It looks a lot worse than it is, but all it's doing is listing out all of those elements from the previous slide to come to a conclusion, really. Is the change going to result in a net profit or a loss? So in this scenario, making a change on the farm, so the new enterprise will bring us an income of £40,000. We're going to save on the fixed costs of the old one of £16,000. So we're up 56. But on the other side, we've lost out on the income of the old enterprise of 45, and we've got the new costs of whatever we're bringing in its place. So actually, in this scenario, there's a net loss. So on paper, it's not worth our while changing from one enterprise to the other. It doesn't need to be much more complicated than that. And actually, we can quickly evaluate based on that. It's quite black and white. We can compare the additional benefits to the additional costs. If there's a positive outcome, it effectively says that we can proceed with the changes. But if there's a negative outcome, like in this scenario, we might need to reconsider or explore alternative options. Now, obviously, that's quite simplistic, and there's some pros and cons to this as well. So actually, partial budgeting is quite good for those what-if scenarios. Would 150 cows cover my fixed costs rather than 100? Or how many extra cows do I need to allow me to bring my son or daughter into the partnership? So comparing what would happen if one part of your plan is to change is quite good in that scenario. So swapping spring barley for winter barley, or perhaps the other way around, due to the increasingly wet winters, you want to go for more spring cropping. There is drawbacks to this. It's not just as simple as swapping out gross margin income and costs in real life. There's a lot more to it than that, and we all know that. It's assuming the constant external factors which just don't exist. So if I was to take the example I gave of swapping suckler cows for spring barley, well, do you as an individual, do you have the experience or the expertise to grow the crops? Is the land you have suitable for the harvesting equipment? Or maybe it's a case that the cows are just performing poorly. Could they be improved? These are the sorts of questions that a simple partial budget won't answer for you, but it's still quite useful as a black and white yes, no in terms of the basic figures, provided that you're happy with the assumptions that you have in the background. Another disadvantage here, which I talked about with the gross margin budgeting, is that it doesn't really consider the impact on the cash flow. For example, in your first year of growing a crop, you've got your full year of costs before you have any income. It might be the case that your cash flow can't sustain those sorts of changes, even if the end result at the end of the year is a positive one. So that's something to be wary of. So I think that brings me quite neatly onto looking at cash flow forecasts as a budgeting technique. So this is quite a popular and quite a practical method of budgeting, as we consider not only what the output of the business will be over a 12-month period, but how that works day to day and where that money lands. So again, in a cropping calendar, you have all your costs up front, and you don't get any income until the end of the crop year when you finally sell what you've grown. Is the business able to handle the demands of cash throughout the year and actually remain liquid? Can you maintain that liquidity of your business? So mapping out when these costs are going to occur will help you see when the pinch points in your finances will be, and perhaps where you need the most financial help. So being aware of those pinch points through good planning is key. So really it allows for better use of finance rather than just knee-jerk reactions to short-term pressures that your cash flow might be under. So cash flow forecasts are something that are commonly asked for by lenders. So if you're looking to get a loan from the bank, you'll often need to produce financial forecasts to demonstrate the viability of the venture, and cash flow forecasts are quite a useful way to demonstrate this. So as I mentioned previously, it not only shows if something has the potential to be profitable, but if the cash reserves have the ability to deliver the business through to the realization of those profits that are potentially there. So generally, we would look at cash flows on an annualized basis, whether that's just for 1 year or perhaps 3 or 5. But there's no reason that we can't do that over the shorter term, particularly if there's any need to keep a tighter eye on finances, perhaps if they're close to an overdraft limit, these sorts of things. Managing it on a much shorter basis can easily be done, and monitoring it is more important than making it in the first place in those scenarios. So how do we actually start to build up a picture for this? This information in some ways applies to the previous methods that I've talked about as well. Where do we get our information from? So start with what you have is what I would generally advise people. Use the information that you already have there. If your accounts are what you have, use them. It's data from your own business. Particularly on the fixed cost side, that's something that can vary quite significantly between businesses. So using that data is really helpful. Have you got a detailed breakdown of what's in the accounts? So that detailed breakdown, accountants will call the nominal ledger. So that might be you might be able to ask for that from your accountant, or probably available from your account software. If that's something that you manage yourself or have access to yourself, you could get that information. But ultimately, once you have these sources of information, it's up to you to use your knowledge of the business to identify where these costs and where these incomes are going to fall during the year to correctly map out the timing of those inflows and outflows. A second source of information is using your forecasted gross margins that you perhaps came up with in the first instance that I discussed. So we've got our historic data, but actually sitting down with your gross margins and trying to forecast where you think that's going to be, updating that with current livestock prices, current milk prices or grain prices, using up-to-date fertilizer prices as well, can make a really big difference over the historic data that you have. Trying to make the most accurate assumptions that you can will just make the process just so much more valuable. Yes, and using these forecasted margins, it really gives you a prompt for what to include within your cash flow forecasts as well. So over the next couple of slides, what I've done is I've included an example of 1 year from a 3-year cash flow for a small farming client who finishes some beef cattle each year. It's a really small enterprise. But in this case, the cash flow forecast was designed to be used in a business plan for a small loan. Obviously, I've skimmed it down to try and fit it within the slides here as an example. But what you can see here is our starting point. So what I've done is considered what all the cash inflows are for the farming business. So now in this case, you can see there aren't that many moving parts, but you can start to see for a larger agricultural business, this can start to turn to a much bigger list. It's important that if you're going to the work of creating a cash flow forecast, which can be quite labor intensive and time intensive, that you do sit down to consider all sources of income and expenditure that are relevant to the business. Secondly, given that it's a cash flow forecast, the timing should be based on when the cash is actually spent or received, as ultimately we're trying to monitor the bank balance here throughout the year rather than just thinking about the profit or loss like we would in an accounts scenario. So if I move on, here's a summary of the cash outgoings in the year. And of course, that list's a lot longer. Hopefully you're able to see some of this information. I appreciate that's quite squeezed in on the slide, but even if you can't read it properly, hopefully it gives, starts to give you an idea of what's included. You can also maybe see how for both the income and expenditure, gross margin budgeting is a useful starting point, as it provides you with the information on what some of the totals would be for an income and an expense line, and it's up to you to use your knowledge to spread that throughout the year. Considering the timing of payments is where cash flow forecasting can help bridge some of the weaknesses of those previous higher level annual analysis techniques or budgeting techniques. So a few things just to remember, really, if you're looking at cash flow forecasts. Don't forget to include your fixed costs. That can make a really big difference. And for each business, it can be quite unique. So if you have an understanding of your own fixed costs, that's definitely what to use rather than trying to use any sort of industry numbers within that. Drawings is another line that I quite often see left out or forgotten about. So those might be regular. As we can see here, there's drawings of £600 a month, apart from the very last month. Or they might be a bit more ad hoc. Are there any big one-off expenditures that need to be considered, like personal tax bills in January or July, those sorts of things? Any equipment purchases? The detail from this cash flow in future years, or actually within this year, you can see has allowed the planning for machinery purchases later on in the year, knowing that it can be done without going into the overdraft or requiring finance. And that's only been really possible by planning out all of the income and expense here. Once everything's included in a cash flow forecast, you're quite quickly given some key pieces of information, which I've highlighted here with the red circles on the screen. The starting point is going to be the net cash flow position each month. So obviously, due to the nature of farming outputs, there will be plenty of months of the year where this is a negative, because there might only be certain months of the year where we have an income at all. So perhaps more importantly than just looking at the net cash flow is the ability to track what the bank balance will be throughout the year. So what we can see here with the two other red circles is by the end of the year, the cash position will have actually dropped in this business. But that doesn't mean that the business has been failing. We've been able to plan for the future and plan investment based on an informed decision. Taking this cash flow further to projected profit and loss statements, this business was actually projected to make profits for this year. And you can see actually there's been investment in machinery as well, which is really one of the reasons why the bank balance might have reduced. So thinking then about cash flow forecasts in their totality, they do give an insight into future cash availability. So whether that's planning for investment or perhaps sometimes planning for when the belt needs tightened a bit. If you know that things are adrift, going to your lenders and saying that you know things aren't working, but that you know why and you know what you're going to change will really help you keep lenders' confidence. Trying to do this, trying to have that sort of conversation months down the line when money is difficult is going to be a really hard task, and lenders may lose confidence in the business if it can't manage its own finances. Ultimately, it's only as good as the information that you put in. So my key advice is, if you're presenting to the bank a cash flow forecast, then make sure you proofread once you're finished. It might sound really silly, but actually mistakes in these happen all the time. They can be big chunky documents. There's a lot of moving parts. If you make a change in one year, it knocks on to years 2 and 3 and wherever else you go. Is your opening balance right between years? Are the movements in the month right? If your numbers are clearly wrong, then you quite quickly start to lose a bit of credibility within there. Obviously, some things are outside of our control. There's not, we're not always able to perfectly forecast where things are going to go to. But with sitting down and putting in a good amount of planning to this, you can get a really valuable document, which can be really useful for your business. So how do we go about all this? So I sometimes tell people it's a bit like exercise. If you can do it, great. If you can do it regularly, it's going to be much better for you. Even more than that, the experience of budgeting itself will make you better at it. It all comes with practice. If you just think about it in a practical example, the first field that you ever plowed might not have been great. Your first budget might not be much better, but experience ultimately helps. So getting started is really important. And actually, from then on in future years, you'll have a template for your own business that you can build on and work on and make more helpful in your own scenarios. It's really important to include accurate and also honest data. If you can't be honest with yourself in this process and make sure all sources of income, but primarily expenses and outgoings are included, then it won't be a worthwhile process. As with most things in life, the limiting factor is always the quality of information that you put into these things. If you don't have all the numbers yourself, other industry numbers are available, which can help you with this. So we've got things like the Farm Management Handbook, which I pointed out already, or there's the old QMS costings numbers. They can be quite a good starting point, particularly if you're looking at starting new enterprises or for things that you don't perhaps have the historic data for. But using industry numbers isn't good enough. You need to try and make it specific to your business. Secondly, to get value out of it, it has to be something that's regularly reviewed. No matter how well you plan, no matter how much detail you put into it, it's never going to work out exactly as you planned it. But that doesn't mean that the process needs to be in vain. Reviewing and adjusting it as circumstances change is really important. And actually, you'll be able to track as the year progresses how things are going. And perhaps, if things are going adrift, you can make the changes as you review it rather than waiting to 12 months down the line and wondering why that cash flow forecast in the drawer didn't work out. If you can do as well, try and go a bit further, go beyond those numbers. Again, like I talked about with the partial budgeting example, the numbers only tell us one side of the story. You as the business owner will have a good understanding if changes that you need to make will work in reality. If you're suggesting changes, do you have the labor capacity for that? Do you have the machine capacity? Is your land capable for the changes that you're proposing? Maybe you're thinking about planting crops, but your pHs are all wrong. Things like that. It's getting those fundamentals right outside of just the numbers as well. Sometimes we can, dangerous to say as an accountant, but sometimes we get a bit too bogged down in the numbers. But this is really valuable, but it's thinking about the whole picture for your farm as well and what that means. So now, if we take this information, we have a budget for the year ahead. What do you do with it? As I've alluded to already, hopefully the answer is not print it off and stick it in the drawer. The more a budget is used, the more value that you're going to gain from it. So regularly reviewing that budget and updating the assumptions in it and the outcomes as time progresses will make it a much more valuable planning tool. If you're starting out, try to think in advance when you're going to check in on your progress. Is it just quarterly after you've completed your VAT return and your figures are back up to date? That can be a really easy check-in point when you're already thinking about your VAT returns and your figures at that time. Go a bit further. It doesn't need to take that much longer, and you'll gain a much better understanding of how your business is performing. Just because we spend time making a budget doesn't mean we're always going to get the answer we want either. So spending time up front to realize that a new venture or continuing with the status quo isn't going to work is a much better use of time and resource than getting there and not knowing why it's failed or why cash has run out. If you have a willingness to act on the results, that's where this whole process is really going to start. adding value to your business ultimately. So it's okay to ask for help with this sort of work. So that can be for any number of reasons. I'm personally involved in quite a bit of business work with a lot of different clients across Scotland, and there's many reasons for why that is. It might be lack of confidence in your own financial literacy, but often it's just due to lack of time or lack of experience in doing that. Make the most of people around you, whether that's friends, farming friends with experience, mentors, or even consultants who will charge you for the pleasure, or sometimes even a good, knowledgeable rural accountant as well. But actually, the benefits almost always significantly outweigh any cost associated with this. Aside from that, though, there are a few other places people can go for more advice on these matters. Business Gateways is a particularly useful organization, especially for smaller or new businesses. They provide a lot of support and advice on business planning or cash flow management or marketing. And you can contact them on their website or via their local offices, which are across Scotland. Another one I thought would be worth pointing out is RSABI as well. So they provide free and confidential support for those connected to agriculture in Scotland. They have a 24-hour helpline for anyone who's needing someone to talk to, whether that's about farm finances or actually just any other stresses you may be coming under. Funding is actually available through RSABI to get a business review carried out of your business by a professional consultant if you're struggling and you need a bit of help in that scenario. And a consultant will be able to come in and put a plan in place to help you move forward as well. So don't feel like you're on your own with this and that you have to take responsibility for ensuring success on their own. There's lots of support as well, particularly through the Farm Advisory Service. If you go onto the Farm Advisory Service website, there is a helpline where you can get free advice from a consultant, which can help you with business planning or actually any other aspect of your farming business as well. So that's been a bit of a whistle-stop tour through business planning. Ultimately, how do I summarize this? Writing a business plan is not about producing a document that accurately predicts the future of your farming business. It's really the process of writing your plan is what's important. Writing your plan and reviewing it regularly gives you a better window into what you need to do to achieve your goals and ultimately to succeed. So if anyone has any questions, my details are on the screen. If you want to get in touch with me in future on anything like this, you're more than welcome. We do also have the chat functionality here as well. So I'll maybe pass back to Osla to see if we have any questions that need to be picked up on.
There's a question that's just come in. Gail asks, have you any experience with the likes of Figured software?
I do, yeah. I've used Figured before quite a bit actually, and worked with some of the guys within the Figured team itself. So Figured is a farming specific forecasting tool. So it links to Xero. So in the UK at the moment, it really only works if you have Xero accounting software. That's the easiest. That's the easiest way. It has to link to a Xero account. Straight out the box, it's a really competent cash flow forecasting tool. It can use your historic data. It can pull that in as a starting point, and within a matter of minutes, you can start with the status quo and quite quickly play about with some of the parameters in there. It's something you have to pay for monthly. It's not free by any means, but actually, if keeping on top of your finances is something that you're wanting to do, it's a really good tool. I've used it before and would quite happily recommend it to people to use as well. Again, there's lots of other tools as well. They're not all agricultural specific. Figured is a good example of one that is agricultural specific, which is quite good. But with any of these things, particularly if they link to your account software, what I would say is only put in what you want to take out. And what do I mean by that? There's the functionality within a lot of these softwares that you could analyze things to the nth degree, which is great if you're going to do that. But too often I come across people who are start with the right intentions and set these things up, but split it into lots of different categories, and they want to analyze perhaps this set of calves differently to that set of calves and all the rest, and you actually just make a burden for yourself. So start with the basics, make sure you're getting those right with your business planning and build it up over time. Don't tie a chain around your neck that you're straddled to and then you get disillusioned with and leave behind. So yes, there's loads of brilliant pieces of software out there. Figure's a really good example of one that I'd use and happily recommend to people too.
Any idea of the kind of monthly costs people would be looking at with that?
I would need to double check, but if you go on their website, it's quite readily available.
The recording will be available afterwards. We'll put it on the FAS website, but it will actually be sent out to you directly as well with the feedback email. So that will give you a chance to review any bits where Andrew was maybe taking us on a quite speedy romp through a lot of quite technical things. But yes, please do remember, as Andrew said, that there is also support available through the FAS programme. You can have a half-hour call of free support on absolutely any topic through the FAS helpline. That the number is there on the side of the screen, 0300 323 0161. Another question has just come in. Can you use this format linked to diversification? Do you mean, Myra, with that the format of budgeting and looking at your different enterprises, or do you mean connected to Figured software?
So Figured, I'll try and tackle both. So Figured
Okay.
software is primarily focused on agricultural enterprises. So that would be looking at your crop production and your livestock production. But actually you can just use it for high level cash flow forecasting for any other diversification that you might have linked in there. In terms of what I've covered in my presentation this evening, I do appreciate that's quite a lot of ground to cover in a 1 hour webinar. But yeah, the principles of this are very much ring true, no matter what industry we're looking at. I've just tried to make it as agricultural specific as I can. But yeah, we can definitely do this across any diversified income streams.
Does that answer your question, Myra? Yes, she's happy with that. Great. Very often with a lot of these subscription softwares that you can get access to as well, they do have a freemium model where you can try them out for certain things and just have a play around with them and see if they're going to suit you before you commit to signing up to a sort of an annual subscription or a monthly subscription. And it is a good idea to just have a play with them, see if they suit you. It can be something that can really help if you can have them on a laptop or even on a mobile phone. You're then able to carry around with you in your pocket a data collection service that will help you do that budgeting and to, as Andrew says, review it really regularly. It sounds so much like going to the gym that it's unbelievable. Everything has to be done regularly, and don't start big and then tail off, but start small and build.
Definitely.
If there are no other questions, then we'll let you go and get a cup of tea and ponder on when you're going to start your budgeting future.
Perfect. Thank you very much. If anyone has any more questions in future, feel free to take a note of my details and get in touch with me. And I'll be more than happy to help out. And I think we'll be able to share our poll before everyone leaves as well.
Yep.
Just to grab some feedback.
Okay, I'll just share that poll on the screen now. If you could just take the time to just answer those 3 questions, that would be super. Thank you.